This contract trades the opposite of equities because this is a volatility index. And if you don't understand volatility, you should not trade options, because if you look at my other videos, what you'll see is there's a repetition around value of options being three components: time, the stock price relative to the strike, and the implied fear, implied demand, or what option pros call implied volatility. So I want to talk to you about how you can buy a put when you think the market's going down. So let's look at how we make money when we buy a put. Now, if you look at the bottom of my screen, this little purple line has gone from below 1, which is 100%, to above 1.5. If you look at the trend over the last month, what it tells you is that volatility is at an all-time high, and volatility is going to come down. That's important to know if we're buying an option, because when we buy an option, we want the volatility to go up, not go down, because it can really hurt us. So we're going to have to think of a strategy where we can buy a put where if that volatility goes back down, that we don't get hurt. So let's go ahead and look at the puts in here. I'm using the Thinkorswim mobile platform. This will make it easier for those of you who like to watch my channel on your iPhone. So what I'm looking at here, these are the different expiries and these are the vols. You can see if I go out to June, it's 89 days with 154% implied volatility on average. And that in 154% implied volatility suggests or implies that this thing is going to move 44 points either up or down between now and then. That's just another way to think of implied fear or implied demand. People are expecting this thing to move a lot, and so they're willing to pay more for the options. So we're looking at 90 days out, and I wouldn't go any shorter duration than that because you get theta decay on your pricing. So you pay more to go out, further out, but you don't get as much decay on a daily basis. Time decay we'll save for another time. But let's go down here and let's take a look at the 50 put. Calls on the left, puts on the right. I'm going to hold this down and take a look at this put, and I want to look at a chart. This put traded a high of 15 about a week ago, and this is showing a 6-month daily. So this one has not been liquid, and it's only been trading for about a week. Before that, no one even traded it. In fact, it probably didn't have a strike price back then. But it's trading at 15, a low of 7, and it's just shot back up to around 12. What we're going to do is we're going to wait for Monday morning when the market's going to be crashing. Vols are going to go back up, and this thing's probably going to drop from 12 back down to 7. If it does, that's going to be an opportunity for us to try to buy a put. And what I would do is I would buy the put first and wait and see what happens. But whatever I pay for this put, if I buy it for $7, that means $700. I'm ready to lose the whole $700. And then what I'm hoping is that it goes up in value. And if it does, I'm fearful of a drop in volatility or implied fear. If the market rallies and the VXX starts to drop, then people won't be as fearful. And if they're not as fearful, then the value of the put will go down, even if the VXX goes down. So what I'm going to look to do is if that goes to 7, I'm going to go to the 40 put. And I'm going to look at that 40 put. And obviously, it was just trading at 4. And right now, it's trading at 6.5. So I have to think about, like, if the put starts to make a profit after I've bought my one put, and the market's starting to go my direction, if this put starts to go back up, if I can buy the 50 put at 7, this one's probably going to be back down to 4. Then I have to wait for the market to move so this one goes back up. And then what I would like to do is to sell the 40 put after I bought the 50 put. And if I do that, I can reduce my risk, and at the same time I can also eliminate the impact of implied volatility or implied fear going down, because these two will offset each other from a fear perspective. And whatever is the differential between what I bought and what I sold, that's how much I pay for the spread, and the most I can make at expiry will be the difference of the two strikes. 50 minus 40 is 10. The most I can make is $10, so hopefully hopefully I can buy this spread for $1 or $2 and make anywhere from 500 to 1,000%. So that's kind of my thinking around buying a put. And these are the two strikes I'm looking at on the VXX. Go out probably to June or even later when I do this trade. So that's just a simple overview of what's a put. It allows us to make money when the market goes down. Let me know what you think in the comments. Does that make sense? Did I confuse you? Did that help? Did that hurt? Let me know how I can make that better. Thanks.